Good morning. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we're here to talk about CPI. Have a couple of colleagues here with me to do so. John Authors is with us this morning. He's the author of The Fearful Rise of Markets and also writes an incredible newsletter for Bloomberg Opinion. Allison Schrager is with us. She's a senior fellow with the Manhattan Institute, Bloomberg columnist, and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. The story here today is that it is the last CPI report that will come out in the calendar year of 2024. Of course, it's not the last 2024 CPI report. That one we'll get in January, but it could set the tone here for the year ahead. I think the month-on-month figure is expected to come in. This is the consensus in the Bloomberg survey. It's expected to come in at 0.3%. Seasonally adjusted. The core, which excludes volatile food and energy, also expected to come in 0.3%. And then you translate that into your year-on-year figures. That ends up being a 2.7% and a 3.3% for core. A couple things going on under the hood. We'll give it a close look when the numbers actually come out. But broadly speaking, one of the reasons that we're expecting a bit more pressure this month, upward pressure, is because those pesky used cars keep going up. We have a little bit of visibility into those because we get the auction data from Manheim and other suppliers. We'll also be looking closely at apparel and airfares. And on the downside, some people are saying there could be risk, so to speak, that shelter actually softens. The pace of inflation softens a little bit here. It's one of these waiting for Godot things. We talk about this every month, and it continues to frustrate us. So we'll see. But the long and the short of it is we got a little bit of a late start here today, so the numbers are going to be with us in just about 30 seconds. But John, in that time, anything particular you're looking for here this morning?
Super core matters as ever because the Fed thinks it does.
Super core.
That is that's services excluding housing. If you have a continued stickiness, continued sign that inflation hasn't gone away, that is a problem.
Sure. All right. So let me bring you all the numbers. It comes in on expectation. 0.3% is your month-on-month. 0.3% is your core month-on-month. Year-on-year, that translates to 2.7% and 3.3% for the core. I will very quickly take you over for some market reaction. Here for representative fixed income market is your yield on the 10-year Treasury note. You see a knee-jerk reaction with yields dropping intraday from about 4.24, 4.25% down to the range of 4.22, maybe 4.23%. A little bit of a drop, that is to say, prices up, yields down. John, coming back to you because I cut you off there. Does this number do anything for you off the bat?
It suggests to me that we do have one more cut coming. I think you need to have a fairly clear surprise for the Fed to decide that they were not going to cut next week, and all the arguments are well addressed. But at that level, I think they feel there's nothing to stop them cutting once more. And I find the idea of a hawkish cut, which has been much discussed, I think that makes a fair amount of sense. That they'll cut once more to give them maneuverability for next year, but basically say that's your lot, or at least studiously refused to promise any further cuts from there. This is a number that is irritatingly high from the point of view of the Fed, but not alarming. Doesn't suggest that inflation is truly taking off again.
Okay, Alison, John lays out sort of a fine line that the Fed is going to try and walk after this number. Would you share that interpretation? This idea of a hawkish cut coming up next week?
Yeah, I mean, the Fed is sort of in a tight position because it does seem like, well, maybe the last mile wasn't the hardest. The last half mile is turning out to be pretty hard.
Yeah.
In the meantime, there's a lot of inflationary pressures in the pike for next year. So it's important to the Fed's credibility to feel like, okay, we beat inflation and we really beat inflation. So I think, is it like, I'm not convinced that we need a rate cut for economic, but I am convinced we need one for credibility terms. To say like, all right, we pretty much got our job done, and then fiscal policy next year, not our fault, and we have the tools to deal with it. So I mean, this just might be our new normal, or a new normal that we feel nostalgic for in a couple of years.
Yeah, I'll take you quickly through some of the line items in here in case anything pops out at Anyville. New vehicles end up going up. This is month on month, seasonally adjusted, 0.6%. That's a strong number. Used cars, I talked about that in the lead in, end up contributing 2%, not contributing. That's the number for that category. 2% month on month, very strong. Now, apparel, pretty muted, 0.2%. This thing has been all over the place, and maybe it has something to do with the way that our holiday shopping season patterns are changing, or something to that effect. But we had a big print, what is it now, back in September, and then you had the payback from that, where apparel was actually showed deflation in October, and then we just get a 0.2% here. So essentially, volatility. If you were worried that there was something more to the apparel story, maybe you don't have to worry as much right now. One that I would point out, persistent thorn in everybody's side, especially Jerome Powell's side, is shelter. We do see this stepping down a little bit. I'm almost interested in seeing what it looks like to 2 decimal points. So much attention that is paid to this number, but shelter inflation month on month ends up being 0.3%. That is a step down from the 0.4% pace, but still elevated. That's still the kind of thing that's going to keep your year-on-year figures on the high side. John Authors, doggone it, I can't believe we're still talking about used cars. Come on.
Yeah, and there's still a measure. There's a Stepford measure of inflation, excluding food, fuel, shelter, and used cars.
Yeah.
Very strange random number or it seems to me to be a random number which they started publishing in the in the transitory inflation year 2021. Tried to show that it was just about used cars. Yeah, it's fascinating, isn't it? And it's obviously a matter of some considerable impact on people's lives. I mean, we spent the election, all the different arguments about what aspects of inflation actually matter to people and what don't, and that tends into a sort of elitist versus anti-elitist commentary, which perhaps is a little unfair. Right. But yeah, there are a number of aspects of inflation here which would still probably mean that the basket that you're needing to buy if you're a relatively low income person is inflating faster than the basket you want to buy if you're a relatively wealthy person. That hasn't gone away. That sort of canker on American and the Western economies of inequality and a sense of unfairness just doesn't yet go away.
Yeah, for sure. There was always some nuance to that debate, though. Allison, I wonder what you think about all of this, right? Like part of it. So the critique was that years ago, a number of people would say, headline inflation is high, but look what happens if you exclude these, key items. And then, people came back and made fun of that because they said nobody actually experiences an inflation basket that excludes shelter, food, and energy. That's ridiculous, and it's heartless. And it is heartless, but to be fair, what we're trying to do here is not describe real inflation to the American people. We're trying to identify some sort of signal in the volatility, right? And in that respect, it's still the case that if you forget about used cars right now, because that's sort of a recent month-to-month phenomenon, it's still the case that if you take the shelter component out of this picture, that the year-on-year figures basically look like inflation is no longer an issue in the United States of America. It's still the case. So Allison, like, the Fed knows this. Jerome Powell knows this. He talks about this on a regular basis, right? So why are we seemingly still targeting one component, inflation, when that component is shelter and we know that it has lags?
Well, as you said, what they're trying to do, the Fed is trying to think of, well, they have all these other components which actually matter to people, but they're volatile and not maybe, say, well controlled by monetary policy. Yeah. Which I know, people want to feel like someone's in charge. And I think we should also be a little, I don't know, it's concerned because it is volatile, but food away from home is up a lot this month. Okay. And that is,
that's restaurants for the regular folks.
No, sorry, I misspoke. Food at home.
Food at home, okay.
Food at home is up quite a bit. While food away from home is pretty much where it's been. So I'm sympathetic to the Fed that, there's not a lot they can do. It's a very volatile aspect of prices, but we have also learned in the last couple of years, food at home seems to be what matters to people most, because this is just, we complain about groceries all the time, and for good reason. I do too.
It's not something the Fed can do all that much directly about, though.
Yeah, which is
one of the control over.
Like, I've been thinking a lot. I've been reflecting a lot as an economist that, what have we gotten wrong? I sort of have a lot of dogma about certain things that everyone else hates. And I'm like, maybe I should rethink this. Maybe I should be more open-minded about tariffs. And so I feel like the Fed is sort of in a similar spot when they're like, well, we can't do much about food prices. We control what we can control. But I sometimes think, well, we're not wrong about these things, but we've got to get better at communicating and being more sympathetic to what people are experiencing. And, people aren't going to like that as they're making their Christmas dinner, food prices are up a lot.
Yeah, exactly. I think you're very right about the aspect of communication, because the number of people who think, as like John was saying, that the concept of core inflation is heartless, it's meaningless, it's the Fed trying to make it look as though inflation isn't as bad as it really is. It's actually about humility and about being humble and admitting that let's exclude the things we have least control over and look at the stuff where our monetary policy might actually have an impact. And at the moment, core inflation is actually higher than headline inflation. So it's certainly not trying to make the situation look better than it is. So it's a perfectly natural view, which, judging by my inbox, is a widely held one, that there is something elitist and heartless about looking at core inflation. But there really isn't. And I guess the other point one can make is if you exclude shelter, we're back to 2% or whatever, then that does raise the issue. But most people do need a house. They do need to pay rent or mortgage for some kind of a dwelling. So you can exclude shelter as well, but that still has the impact of meaning that you're not looking at the total basket of what people need to buy to survive.
Yeah. Well, that's a good lead into our decomposition exercise here. So I've put up the ECAN screen on the Bloomberg terminal here. Really one of the coolest tools that they do here these days. And what this does for us is tell us exactly where the month-on-month seasonally adjusted inflation is coming from here. And I just wanted to take people through this really quickly. I described some of the line items earlier, but we're just going to do this a little more carefully here. So if you look at the most recent month, the one that represents inflation for the month of November, it's going to be over here on the far right-hand side of the picture. And basically what you're seeing is you've got a yellow bar, and that block represents the contribution to the 0.3% month-on-month inflation from core services. Core services encompasses a lot of stuff, but the biggest chunk of it is indeed that shelter. It's rent of shelter. It's something that we call owner's equivalent rent, which is essentially a proxy for the quote-unquote inflation that homeowners experience. It's complicated, but it's how we do it. You have a purple chunk here, which is coming from those core goods. That's going to be largely your automobiles, new and used, that we talked about at the outset. To be clear, used vehicles in particular have experienced quite a bit of deflation over really the past couple of years, and we've recently seen a little bit of a bounce. Unclear if what we're just seeing is sort of a leveling off of used car prices, or maybe a more durable a bounce, but in any case, it is starting to contribute again on a month-on-month basis. Those are automobiles, cars and trucks. And then lastly, you have a bit of a positive contribution from exactly what my two colleagues were just talking about, food. Food really contributing just about, food was also a meaningful contributor to the September number, but it's been some time since we've, barring that September number, it's been some time that we've seen this much contribution from food in these numbers. So, again, the big movers here are basically your cars, your core services, and your food. I will briefly just click into the yellow core services piece so we can see what else is going on under the hood. Once again, the biggest chunk of the biggest chunk ends up being shelter, right? So in this graphic that I've just taken you through to, that ends up being sort of an orangish thing, and then in addition to that, you have a smattering of other contributors. One thing that may be a little bit encouraging to people. Transportation services not contributing in a positive way this month. Transportation services includes that pesky automobile insurance, and it's not so much of a problem this month, even though it has been quite a problem in other recent months. You do see a meaningful upward contribution as well from recreation services, contributing about 0.04. Recreation services includes stuff like, video and audio services, photographers, pet services, including your vet bills, stuff like that. So, if you look around the edges, it's not just shelter. You did have this particular month, the bounce in the automobiles. You had the stuff going on with recreation services, and very importantly, you had food, which my colleagues just said, really hits people where it hurts. And another thing I think that food and energy both do this, John Authors, is food really affects our inflation expectations. And
Yes.
you've been doing some writing about inflation expectations.
Yeah.
I wonder how you're thinking about that after this number here.
Well, it's fascinating. I mean, there's been a big debate within the Fed about how important expectations are, but there's certainly an argument that in terms of the kind of behavior that will lead to inflation, in terms of people adjusting their consumption so that they will in a way that might cause prices to rise, that will indeed be higher. There's going to be more inflationary pressure. People expect higher inflation in the future. What's fascinating at the moment is the way that politics intersects with everything. So if you look at the mean rather than the median inflation expectation, for average inflation over the next 5 years, it's just under 6%. So there are, the median is under 3. So evidently there are a lot of people out there. There is a very significant group of people who think inflation is going completely off the rails again, that we're going back to the 70s. And that's a relatively small group. It's probably overrides, or is in line with people who are who have been very unhappy with Joe Biden, that it will tend to be people on the political right who really think inflation is going to take off. But this is a very strange phenomenon, and it's new. The mean tends to be higher than the median. The gap between the two has never been this great, and the numbers have been, I Michigan, for whatever it is, I think it's 50 years. So that is a very strange phenomenon. Then you have the issue that if you're a Republican, you thought inflation was going to be 8% a year 2 years ago, and after the election, the latest number is that you think it's going to be 1. And if you're a Democrat, you have thought that inflation was going to be running at under 2% for the last 2 years, and now you think it's going to be over 3. So just the political transition creates very, very weird cross currents for the central bank to try to negotiate. That adds into what Alison was saying earlier. I have generally, without thinking about it too hard over the years, been of the view that tariffs are a bad idea. Go free trade, etc., etc. There's plainly a mandate for tariffs now, but there is also plainly a mandate for not letting inflation take off. If food inflation takes off and gets back to where it was under Biden, then the Trump administration knows that it has to do something about that, and that might involve getting into a big fight with the Fed. It could involve giving up on tariffs. We don't yet know, but that is going to be the critical call. If tariffs and the fiscal policy have the inflationary impact that most of us tend to assume they will, what happens next? That will be a fascinating call to be made. Maybe by about a year from now, we'll have some more clarity over this. But that is the big question going into next year. Is Trump inflationary, and if so, will Trump 2.0 change course?
What do you make of all this, Alison?
What you're saying is important on a number of levels, and even if we do end up with low inflation, the fact that there's so much uncertainty around what inflation is, or people don't agree, is potentially very significant because so much of the term premium on the 10-year is inflation risk, like not just expected
Yes.
inflation, but uncertainty around that expectation. So if people just
Exactly.
feel less confident about what inflation is going to be, no matter how great our monetary policy, even if Trump comes in and he's just like fiscally disciplined all over the place, which I'm doubtful, but maybe, we could still end up with a bigger 10-year, which are going to affect mortgage rates and a lot of aspects of consumer debt and hit people really like where it lives.
And deficits, right?
Yeah.
So,
Yeah.
and what about the wealth effect channel, Allison? So you've got this combination of things going on. You've got these sort of stubborn prints. I've sort of made the apologist argument for the relatively stubborn prints. You exclude this or that, and well, it's not so bad after all. But you couple that with the fact that, as John says, there are some people out there who remain really, really, really concerned about the inflation outlook. You've got some policy risk here. And you add to this whole soup the fact that asset prices in many markets are kind of going bananas, right? We recently had this Bitcoin milestone. You've written about Bitcoin recently. S&P 500, for all its recent ups and downs, has hit about a zillion all-time highs in 2024. How do asset markets play into this inflation picture?
Well, I mean, I don't, it's amazing because when you listen, I feel like my good gauge of where people in finance think is to listen to Bloomberg interviews all day on the news. And the cognitive dissonance is really fascinating because they're all convinced that inflation is going to take off next year. But I guess they're also like, well, we'll have lower corporate taxes and potentially some deregulation. So I think they're just going with that. Anyway, I mean, I think they should be very concerned, not only that inflation is going to go up, but like, I think the economy, I don't think is still really adapted to the idea that we're going to have to live with higher interest rates for a while. Right. And I'm starting, for a while, I was like, well, maybe that was easier than I thought it was. But I'm also sort of hearing stories of one of the reasons maybe we're not feeling it is maybe it hasn't really hit the fan yet. I mean, I was just reading an article about how there's a lot of private debt that's floating rate, and a lot of those borrowers make their interest payments, so they're just rolling it over into principal. But eventually, they're going to have to pay it. Or even, I know people who are starting to take out mortgages again and buying homes. They're all taking adjustable rate mortgages, and they've been told by their mortgage broker that don't worry, rates will be back down in a couple of years. I mean, maybe, but I mean, they're all banking on this. It's even in their projections, which means, like I said, if interest rates stay high, we might start to feel the impact of that. And particularly if interest rates go up, then I think we're stuck with higher interest rates for a very long time.
Right. Yeah. Right. Yeah. John, I'd love, and this is this will be the last point for us, but I'd love if you'd weigh in on this. Do interest rates themselves feel like the big risk here, at least for the market and maybe the economy in 2025?
Interest rates / inflation. The known unknown, the risk everybody can see coming, but we don't know whether how bad it will be, is that inflation picks up again, and that it's seen to do so in response to the policies for which the new administration plainly does have a mandate. What happens then? If you do get a need to raise interest rates, what Alison was saying is very important. The length of time that interest rates stayed on the floor in 2021 during the quote-unquote transitory inflation period allowed a lot of people to lock in rates for a long time, but that will steadily begin to come off the picture. If rates stall where they are now, or where they are likely to be next week, and then go back up again, it's very likely that I find the argument, the other way you can look at it is Milton Friedman talked about monetary policy lags. The ability of people to lock in those low rates for as long as they did extended the lag this time around, but didn't end it completely. We do need the higher rates are going to hurt eventually if they stay high long enough, and that will basically depend on what exactly happens to inflation once we have an administration in which is making a serious attempt to change things and stimulate growth again. That's plainly what they've been asked to do, what people want them to do. Is it going to cause an overheat, and what happens next? That's I mean, we've just seen what's happened in Korea and Syria and so on. There's plenty of things we can't even think of that might happen next year. But in terms of the big question for 2025, that's unquestionably it that we can see coming.
Yeah, well said, John. We're going to wrap it up right here and now. Your CPI month on month ended up coming in 0.3% for both headline and core. That ends up meeting expectations exactly. Year on year, that translates into 2.7% inflation on the consumer price index in the United States of America. Taking you over to markets, that has translated into a very, very tiny drop in yields on your 10-year note, but we're still wiggling around as we speak. We'll be back here to analyze the Fed decision next week.
All right.
My name is Jonathan Levin with Bloomberg Opinion. Thank you to John Authors. Thank you to Allison Schrager. And thank you to everybody for tuning in.